Cisco Systems has continued to grind out revenue. This company makes a lot of the infrastructure that makes the internet possible. They make routers, switches, they make security devices, and they've been doing it since the origination of the internet. Now, they got a bad rap during the dot-com bubble because they were the beneficiary of the boom and then the bust when it ultimately collapsed. After that, the company has continued to grind out growth, low to mid single digits. Revenue last year, $57 billion of top line revenue. EBITDA was $17 billion, was $17.5 billion of adjusted free cash flow. The company has $9 billion of debt and $16 billion of excess cash on the balance sheet. So they have more cash on the balance sheet than they have debt, which means they have zero leverage. We love that at the Cash Flow Club. You want to find that, right? We look for companies that have revenue growth, earnings growth, strong free cash flow, low debt, and are reasonably priced. And I would submit to you that Cisco fits one of those buckets, especially in this day and age when everyone's getting a little crazy when it comes to the Magnificent Seven and the valuations they are subscribing to this. Do you know that the Magnificent Seven is roughly 30% of the entire US GDP? That's a little nuts in terms of their sales. It's a little crazy to me to think that those 7 companies represent that much of the business. It's also basically a third of the S&P 500 on a weighted basis. If we're going away from what everybody else, what the crowd is doing, you're trying to find something different, I would submit to you that going after an infrastructure company that's essential to the internet, that's grinding out low single-digit growth with no debt, is a great way to park cash for, say, 20 years. Check it out. You can find the one-pager at the Cash Flow Club or watch my video on YouTube where I break down NVIDIA versus Cisco.